Okay, well, welcome. This is our first webinar of 2022. It's a great time to be covering retirement income planning, and we very much thank you for attending. Now, before we get into continued and things like that, let me just quickly introduce my guests. These are two people who truly need no introduction. Ed Slott is nationally known for his expertise in IRA planning and is also a professor of practice at the American College. So instead of reading you his resume, we agreed to just show a picture of him holding up his book that's been such a success, The New Retirement Time Bomb. And since we're showing books, here's a picture of me holding up my new book, Retirement Planning Guide. And when I say my book, what I mean is my copy of Wade's new book. Dr. Wade Pfau is our other guest. He's another famous retirement planning superstar. And his new retirement planning book is a big hit on Amazon. We put a link down below for you. He has sold over 14,000 copies already, and he just came out with this late last year. We'll talk a little bit about the book later on. So let's get started. Okay, a discussion of retirement planning in these confusing times should begin with a quick look at any new or proposed legislation that directly impacts retirement planning. I'll tell you what, 3 months ago, I wouldn't have predicted this, but we have no new legislation and even pending legislation really to report. The Secures Act and CARES Act are old news. And really the Build Back Better bill died in the Senate a few weeks ago. And Secure Act 2.0 never happened, and we really have no new Social Security legislation to speak of. Now, on the regulatory front, we have the new RMD tables and last week's IRS pronouncement on substantially equal periodic payments. Think of the 72T withdrawals before 59.5. I'll discuss those two pronouncements with Ed later, and we'll discuss Social Security here shortly. But Ed, let me ask you this question. What's your crystal ball telling you for likelihood for any legislation affecting retirement plan, specifically IRAs? And do you think they'll carve up the Build Back Better plan? Does Secure 2.0 have any legs?
Well, Secure 2.0, lots of people forgot about that one. And that was maybe one of the most unusual bills to ever come out of Congress, because it came out, and, this is not this is actually true, what I'm going to say, 100% bipartisan support, unanimous, Democrat, Republican, all voted to let the bill out of committee, something we haven't seen. So what does it tell you? It tells you the one thing that we know in this polarized nation: retirement accounts and IRAs especially can bring us all together. Everybody agrees we want better retirement account provisions. Now, so if anything happens with Secure 2.0, and there's not a lot of big things in there, but it has this provision of causing more confusion actually, raising the RMD age. Now it's 72 from the Secure Act. That was a good change. This would go to 73, 74, 75 over a number of years. But I would caution planners, let's go extreme. What if it was 77, 78, 80? It may not be the best thing, because the longer you delay, people like to delay RMDs, but the problem doesn't go away. It doesn't mask the problem or ignore it. It's kind of like the sign in my dentist's office: ignore your teeth and they'll go away. The problem of the IRA buildup doesn't go away just because you don't have to take distributions. See, this is where advisors can add a lot of value, especially in conjunction with tax advisors. Maybe it pays even if you don't have to wait till 72. Maybe if you can get that money out earlier at lower tax rates, it may pay to start earlier. The key principle in all good tax planning is to always pay taxes at the lowest rates. That may be right now. And if the IRA or 401k continues to build and build, because maybe you don't have to take it out till a later age, then RMDs are going to be much larger in retirement, maybe on a higher balance at probably a higher rate. just when you need it most in retirement. That's the worst time to have tax erosion. So that's maybe a good provision that some people think, because it gives them more freedom up until a certain date when they have to start taking. But I wouldn't say that's the drop dead date. I would still look at getting some of those funds out earlier. So if anything passes, that's the major item in the Secure 2.0. There's other items expanding the use of Roth IRAs in there too, especially in company plans. The Build Back Better bill that has the big provision, if anything passes from the Build Back Better bill, these alliterations are killing me. The Build Back Better bill, say that 3 times fast. If anything passes, it would probably only be the outright ban on backdoor Roth IRAs and the ban on what we call mega backdoor Roth IRAs. And the only reason is because it's not a controversial provision. I'm not in Washington now, but I imagine if somebody on the program is, look outside and check out the Capitol building. I don't think you're going to see a lot of picketers outside with signs that say, save the backdoor Roth. You know, it's not a big issue. You know, it is for some advisors and some higher income clients that have been taking advantage of it, but it's not controversial enough. I think if anything passes, the ban on the backdoor Roths will probably be on the train that goes through. And that's for everybody. That's one of the few provisions in the bill, the BBB, Build Back Better bill, that is regardless of income. Not just, it's not one of those things, you know, a high income people, it's everybody. So if anything passes, I think you'd see that go on the Build Back Better bill, if anything passes. And like you said, Steve, they'll probably cut it up into some other digestible pieces and slap it on. That's more likely.
Yeah, and that's the crystal ball. We really don't know. So we keep proceeding. In fact,
but I want to say something else about, you said there's nothing new. The Secure Act, you know, this is a major act, and it's been not getting the respect because it got overshadowed. Remember, this came out before all the COVID hit. This came out December 19, effective for 2020. It's already effective. And as you said, Steve, CARES Act came and went, the stimulus provisions came and went, but the Secure Act isn't going anywhere, and it's going to affect all your clients, especially the ones with the largest IRAs, with the elimination of the so-called stretch IRA. And there are beneficiaries that have to start taking payments on the 10-year rule already. But there's also beneficiaries that inherited before 2020 that get to grandfather. They have to reset to new life expectancy tables. So there's a lot going on there. People that have named trusts, most of those trusts won't work anymore after the Secure Act. And a lot of those plans were never updated. I think it's a major opportunity for advisors to start having these conversations. Look at the estate plans, especially the clients with the largest IRAs, because it's more likely the larger the IRA, say the $1 million+ IRAs, the larger the balance that will be left over to the next generation that might get bunched into a 10-year payout.
Well, let's hit relative to that. Let's hit on another leg on the stool, and that's Social Security. Well, 2 points I want to make on Social Security. First, more and more, I think Social Security is not a DIY concept for most people, do it yourself. Case in point that I want to bring up, you all know about the 5.9% cost of living increase from last year. Well, someone came to me a month ago with her Social Security statement, and it said she was going to get a $64 per month decrease in Social Security payments deposited to her checking account. She wanted to know what was going on because she thought she was supposed to get a Social Security cost of living increase. I had to explain that because of Medicare Part B and Part D premiums being deducted from Social Security, that was the problem. So yeah, the Social Security cost of living went up 5.9%, but so did Medicare premiums. And further, her husband was making a good income, so they were hit with the IRMAA tax, which essentially was a doubling of the Medicare premium because of their joint income. So in her mind, through no fault of her own, her Social Security check was going down. So my point is, people really need help in understanding Social Security as part of a retirement plan. The second part of that I really want to do or point out, I'll throw at Wade, is this whole idea of, the government's in trouble, get it while you can. We've all been peppered with questions about how to deal with Social Security, especially since the trustees report came out with a bleak picture. But Wade, you've done some interesting work with looking at Social Security benefits, even if they take a hypothetical 21% drop in what, the year 2032. So does that benefit drop mean that you should take your benefits early?
I mean, it's a great question, Steve, because that's really where a lot of the attention is. Certainly, I advocate the idea of thinking about, at least for the high earner in a couple, delaying their Social Security benefit to age 70. But the response is often, but Social Security is about to disappear, or it's about to get significant cuts. Doesn't that mean I should get money out of the system while I can? And the answer is not necessarily. Of course, it depends ultimately on what kind of cuts will be in the final legislation for that. But this is looking at the idea that kind of a worst case scenario, what if you turn 70 right in the year that there's a Social Security benefit cut? And suppose that benefit cut is 21%, which is what's expected under the current trust fund proposals, that when the trust fund depletes, there'll be enough payroll taxes to cover 79% of the benefits. And if nothing is done, Congress may have to enact a 21% benefit cut. So looking at that, we kind of show what those cash flows would look like. On the left, if there is no benefit cut, under current law, somebody who could get $25,000 a year out of Social Security or $3,000 a month at their full retirement age of 67, if they claim at 62, they'll get a reduction to $21,000. If they delay to 70, they'll get an increase to $37,200 a year. And you can see the differences in the cash flows from that in the column on the right. And then going over to the table on the right-hand side of this slide, that's where we look at, well, what if there's a 21% benefit cut at age 70? So that applies no matter when you started Social Security, whether it was at age 62 or at age 70. But it's going to eat away at some of the value of delaying Social Security, because you're now getting a smaller increase overall at age 70 due to this benefit cut. So the next slide will then show the implications of that. And that's the table on the left is looking at this idea of a break-even age in terms of how long would you need to survive to get more lifetime value out of Social Security with different claiming ages. And this is based on a 0% real interest rate. So that's 0% plus inflation, which used to be a pretty conservative interest rate. Now that the entire TIPS yield curve is negative, unfortunately, 0% is not even a safe withdrawal rate or a safe rate of return anymore. But nonetheless, using that as an approximation, once you get to age 80 and the benefits you receive at age 80, then it pays to have delayed Social Security, get more lifetime benefits out of the system. The table on the right is with that benefit cut starting when you turn age 70. It will take longer, but not necessarily that much longer. Now you have to make it to 83 instead of 80 for that benefit cut to then circle into still getting more lifetime value from delaying Social Security. And for the typical American in their 60s today, 83 is still below life expectancy. So there's still more than a 50% chance that they'll survive to an age where they'll benefit from delaying Social Security. There is an impact if benefits were to be cut, but it certainly does not overturn the whole idea of, well, let me just take Social Security early because there's going to be some sort of benefit cut in the future.
Yeah, makes sense. And, in fact, let me ask you this, Ed, from a practical standpoint, working with advisors every day, what are people saying? Should you take a haircut? Is it going to be really dependent on what age you are? Because I'm already on Social Security. I'm probably pretty safe. But what about somebody in their 40s? How are they handling this issue?
Well, you're covered, Steve, so who cares, right?
Yeah. I care.
No, I agree. If you can, I always say wait it out because you get the largest check and it's locked in for life. But, it's a bet on life expectancy. There's other people say get it while you can. I don't know. I agree with Wade on that, especially older people. People, I'd say in their 50s or older can pretty much, my opinion, nobody really knows, can count on Social Security for one main reason. Most of them vote. That's all. It's always been a third rail issue. But, on another topic, I was looking just over here at the questions, and a lot of the questions are on something already that I just talked about. And I had a situation in the office here yesterday. I talked about the potential, again, these are proposals, elimination of the backdoor Roth. So this came up with the question, I've seen about, I don't even know how many, 5 or 10 questions on the same thing. If somebody already did the backdoor Roth now, and it turned out the bill was enacted and it was banned. Would it be retroactive? Nobody knows that. So I had a difference of opinion when an advisor yesterday, he advised the client to do the backdoor Roth, which, as most advisors know, begins with this is for people who earn too much for a Roth contribution. So they make a non-deductible traditional IRA contribution, which has no income limits, and then you can convert that to the Roth. So the money ends up in the Roth. That's why it's called the backdoor Roth. So this advisor was having people do it already. And I said, well, I don't know if I would do it myself, because what if they ban it? Then you have to go back and change everything. So the question is, and both Sarah and I and on there, I think, agree that it's unlikely if anybody did it now, they would go back retroactively and say, undo it. So there's one school of thought there, and it depends what you want to do. What I would say is discuss it with your clients to say, do it now while you can do it, because let's say they pass this thing and maybe they'll make an effective date of January 1st next year. The effective date in the Build Back Better bill was the effective date of the ban was January 1st this year. Or they could do it on the date it came through or the date of enactment. So then you would have this hybrid system where people earlier in the year can do it, but later in the year can't do it. It could get pretty messy. So my advice was, don't do it till you know for sure. But I guess there's something to be said, like the other advisor that was saying the other way, do it now because you'll probably get it in under grandfathering. But a lot of questions on that. If you look at the questions, Steve, they're all on the backdoor Roth.
Yeah, not surprised. And that kind of goes to what I wanted to next discuss, was the whole idea of the style, if you will, of the retiree or the prospective retiree. So Wade, I mean, in addition to your new book just being a great overall guide, I'm not getting a commission on this, it's just a great book. You've introduced a new way of looking at the retiree style, and that's going to affect the decisions made and how they do some planning. So I'd like you to just spend a few minutes just describing this RISA concept you have, so that people can realize how you factor that into retirement planning as we go into 2022.
Sure. And so the RISA, it's the Retirement Income Style Awareness. It's research that I did with Alex Murguia, where we were just trying to better understand, getting so many questions from like consumers and so forth in terms of, should I do this or that with my retirement plan? And the answer is always like, it depends on really what kind of strategy you want to use. Now, we know for a long time there's different retirement income strategies. I've talked a lot about how retirement income planning being a relatively new field, there's so many disagreements about the best approach to take. Some people take a total return approach, which is to just spend from a diversified investment portfolio. Some people like a time segmentation or a bucketing approach, where they use bonds to cover short-term expenses and stocks to cover long-term expenses. Some people like what's known as an essential versus discretionary approach, which we actually think can be broken down into two subcategories. Income protection would be more, I build an income floor through simple income annuities or maybe fixed index annuities with living benefits. And then risk wrap is taking on more of a risk element, but that I'm wanting to somehow use an income floor with a deferred, like a variable annuity or RILA, something like that, and then invest for upside on top of that with either income protection or risk wrap. We know these strategies exist, but how does somebody choose one? And I think for a long time, it's just been a matter of kind of having a strategy fed to you based on either what you were reading or what you heard on the radio or in commercials and so forth. And so we tried to really analyze, as a starting point for thinking about a retirement plan, is there a way to assess which one of these retirement strategies might resonate with an individual based on their underlying preferences? And so based on reading as much as we could in different retirement planning books for consumers, for advisors, anything we could get our hands on, trying to get a sense of how people talk about this and what sort of factors they're describing where there's some sort of decision to be made. And we came up with 8 different factors that we tried to look at. And then we run this through a statistical analysis. It's this exploratory factor analysis to just try to see what sticks, what factors actually seem to be important. And we concluded that there's these 2 core factors and then 4 secondary factors that when you put it all together, it really helps to explain a retirement income strategy. Now, if we could go to the next slide, there's a lot more explanation that could go into all this, but to get to the punchline about it, One core factor we call probability-based versus safety-first, and that goes from the left to the right. If you're probability-based, you're comfortable relying on market growth. You believe in stocks for the long run. You believe that if you hold into a diversified portfolio, stocks will outperform bonds and support a higher level of spending throughout retirement, and you're comfortable and happy to do that. If you're on the left of this matrix, this RISA matrix, you've got more of a safety-first attitude, and that's more, you prefer contractual protections. You want something, there's nothing that's 100% safe, but at least a contractual protection provides more safety than an unknown market outcome. And so you really prefer something that will source at least your essential spending in retirement from a contractually based source. Now that factor seems pretty clear. I've talked about the probability-based and safety-first school of thought for about 10 years at this point of these two different approaches to retirement. The other core factor wasn't as intuitive, and that's optionality versus commitment. So if you're on the top of this matrix, you really prefer to keep your options open. You don't want to commit to any strategy. You want to make changes. You want to have the full upside potential of whatever may come. You don't want to lock yourself into any sort of result. Whereas if you're at the bottom, you are comfortable committing to a strategy. If you know it will solve for your lifetime income need, you can take this off your to-do list. You don't have to be as worried about making these ongoing decisions and so forth. And so where somebody scores on these two primary factors gives one of these four boxes. If you're optionality oriented and probability based, that's the total return strategy. That's using a diversified investment portfolio and taking systematic withdrawals from it. And some of the secondary factors there that also play into that strategy, you have more of a front-loading preference. You want to spend while you're alive and healthy and know you can enjoy it, and you're worried less about having to make cuts in the future. You have an accumulation mindset. You're focused more on the risk-adjusted return of your portfolio than on generating a predictable income. You have technical liquidity. You're just, if a brokerage account is liquid, you're happy with that. And that's one of the core strategies, because optionality and probability-based do tend to correlate with each other. That's why that blue arrow is in the middle there, pointing then down to income protection in the lower left. That's the other core strategy. That's someone who's safety first. They want contractual protections. Commitment oriented. They're comfortable committing to a strategy. With secondary characteristics, they have a backloading preference. They're worried about outliving their money, so they're willing to make cuts today to better protect themselves in the future. They have a distribution mindset. They're focused on predictable income versus just getting the highest possible return from their investments. They like the idea of a perpetual income floor. And they think in terms of true liquidity, which is earmarking assets to different expenditures. And then you can only count something as liquid, not if it's technically liquid, but if it's not earmarked to cover some other liability on the household balance sheet. So that's income protection. That's more the world of simple income annuities, of fixed index annuities, to build a floor for reliable income and then invest on top of that. And then the other two strategies, they're more behavioral in nature, and they've always been explained that way. And so time segmentation, it's for individuals that like contractual protections but want to keep their options open. And so a strategy proposed for them was use the bonds, hold bonds to maturity to cover short-term expenditures, invest in stocks for long-term expenditures. And that way you have contractual commitments for the short term, but you have as much optionality as possible. And then the lower right, that's risk wrap. That's more the world of deferred annuities with living benefits for a floor, where you're not, you're comfortable with market growth. And this is really the important factor here. You believe in markets. You want to invest aggressively, but you're worried. You don't want to stake your whole retirement outcome on that. You do have this commitment orientation. You do have this backloading preference. You're worried about outliving your money. And so if you can have a strategy that will also provide technical liquidity, as well as the ability to invest in sub-accounts for upside exposure, but still have that income floor in place to put a guardrail around the outcome. That's the risk wrap strategy. And so we developed a questionnaire that can be provided to consumers to get a better sense of, again, just as a starting point for the conversation, which of these retirement strategies will resonate with you as an individual to think about building a retirement around that, rather than not really having any sort of systematic way to think about this strategy or that strategy, or what's going to work for me as an individual retiree. So that's the retirement income style awareness. And I really view it as step one of building a retirement income plan. And so it's chapter one of the retirement planning guidebook. And then the rest of the book is everything else that goes into fully implementing the strategy once you have that starting point for the conversation.
Yeah, that I really love where that takes the relationship with the client. And for those of you that are RICPs in this call, it's kind of like the next step. It's the way you set up to being able to come up with all the solutions you have. So that's why I wanted to feature that. It's in the book, very readable. And it leads me to asking a question to Ed. It's one of those unanswerable questions, but it got me thinking is, Ed, you have all these great tools to help people and their advisors work through the retirement planning process, and particularly IRAs. How does individual style of the retiree factor into the planning? I mean, there's not just one set way of retiring. What do you do with the fact that you have different styles and behaviors and concerns among those clients?
Well, that's where advisors step up and create value. And as Wade was going through this, I was going through my copy of the book here, and I happen to have that particular part. Mark, that's the key. A lot of the answer to that question is in this little graph here, the RISA matrix, Wade calls it. And by the way, I have an autographed copy, which I am going to, for my retirement, make an NFT out of it. It's the only one. So maybe you'll get one like that from Wade. Who knows? I'm not putting him on the spot, but if you're looking for retirement income. Anyway, to your question, Steve, this is where advisors bring value to the table, because yes, you can read in a book like this and see this, but how does it apply specifically to that client? That's the key to all planning. Every client is different. Their behavioral aspects are different. They have different financial goals, different families. Some people have parents to take care of. I mean, that's the way I used to do planning for all the years. I did planning for 30 years, doing estate and retirement planning for people. First thing I did, I actually drew out a family tree, see who all the players are, who are people concerned about. Are there marriages? Are there divorces? Are there people that can't handle money? Do you have to take care of parents and have money for that? So this is what all these decisions are based on. Are you conservative? All the things Wade just talked about. And that's where an advisor can say, you can get some advice in books and things like that, but I want to know about you. That's what makes it special. People want to hear from advisors. They want customized plans that fit them and their families. They understand the macro, the general concepts and principles, but how does it apply to them? That's where the advisor comes in.
Great. That's why we're needed. Computers aren't going to do it yet. Let's move on to products, because that obviously can be an important part of the whole process. And so, Ed, you've been a proponent particularly in the last couple of years, of life insurance as an RMD alternative because of Secure Act, and that's something I've talked about for a long time. I'm just curious, as we go into 2022, has the recent increase in premiums for life insurance and the tougher underwriting standards, has that affected your opinion, or is that still a great RMD alternative?
Well, I still think obviously price is something to be said for, but something to be evaluated. But I still think, remember, for planners, you have to look at the long-term big picture, not what it costs now, but what you can provide to this family. Not when I say long-term, not just for retirement, but beyond the estate plan, the plan for the beneficiaries. Those are your new clients. So I always look long-term. Obviously, there are costs in anything up front, but even with the higher premiums, in general, I've always been a life insurance fan because I look at the long term, the result at the end of the game. Everything comes down to the score at the end of the game. Look at, I don't know if you're football fans, but if you saw what happened last weekend in the playoff weekend, you had teams, the number one seeds in both leagues, they did everything right for the whole season. They had the best records, but at the end of the game, they blew it. It's results. There's an old saying in football, the score at halftime is irrelevant. Give me the score at the end of the game, and then I'll tell you who won. And that's what planners have to do. Yes, you look at what costs are, but as compared to the big benefit at the end. Now, the Secure Act, all Congress did, I think, was shoot themselves in the foot by eliminating the stretch IRA. They downgraded IRAs for wealth transfer and estate planning vehicles and upgraded things like life insurance. Of course, I'm talking about permanent cash value life insurance. all they did is incentivize us to do the better planning we should have been doing all along. I mentioned before, and somebody questioned it, I'm trying to monitor the questions while I'm talking to you, but somebody said, Ed said that IRA trust probably won't work anymore after the Secure Act. Yeah, that's true, because most of them will be subject to this 10-year rule, and the existing trusts have to be looked at, because under the 10-year rule, and that came up in the questions too, there are no more RMDs after death. It's just one big RMD. Well, if that all gets dropped into the trust at the end of the 10 years, you could have the exact opposite of what the client intended. Most clients want post-death control and low taxes for their beneficiaries. Now you have $5 million being paid out at the end of the 10 years, exactly the opposite of what the client wanted. They wanted those funds protected in trust and huge high trust tax rates. Life insurance is a great alternative to that. Better option, similar to the Roth conversion. Take down that growing IRA now, pay some of the tax now at low rates, and use it if the clients want that post-death control to purchase life insurance and leave the life insurance to the trust. That works better. Life insurance is the most flexible asset and tax efficient asset to leave to a trust. You leave life insurance to a trust, you don't have those tricky RMD rules. You don't have all these tricky and very complex IRA trust rules. You blow any one of them, the trust fails, and lots of them did fail in the past anyway, got very complicated. Oh, and best of all, you don't have any tax, income tax. And life insurance, other than unlike IRAs, can be set up to be outside, excluded from the estate. IRAs, even Roth IRAs, are always included in the estate. So yes, when I talk to clients for years of doing planning like this, they didn't come right out and say it all the time, but every client, especially ones that accumulated large IRAs, wanted some version of these three things: larger inheritances, more control, and less tax. They might not have said it that way, but that's what they all wanted. Leave more to their beneficiaries. They wanted control because they worked hard for the money. They don't want it squandered, and they want less tax. Now, we used to use IRA trust as that vehicle. These conduit trusts work beautifully. Not anymore after the Secure Act. The client doesn't care how they get there. The vehicle that gets them there, they don't care about that. They just want to get the results. Larger inheritance, get used to saying that if you're hearing me, if everybody on the program, because you start talking like this with clients. Here, you want larger inheritances, more control, less tax. Yep. The vehicle, that old IRA jalopy that used to get you there, that's pooping out at death now. Doesn't work anymore. Better option, upgrade to a limo. A life insurance limo, a luxury life insurance limo for the rest of the ride. It works better. What does it give you? Larger inheritances for your family, more control, and less tax. And the more control comes in when you leave the life insurance to a trust, because it can be controlled. You can use your own provisions. You can simulate a stretch IRA, have invasion provisions, whatever you want. Now you're giving the client the customized estate plan that they really wanted.
Absolutely agree. And the way to get the conversation going is to ask to look at their current plan, because I have seen those trusts that have RMD language, which basically says you're not getting anything for 10 years. So it's a great way to start an errors and omission insurance situation if it's not handled. Let's move over to annuities. Wade, so the annuity debate seems lately to have really been over annuities as an accumulation vehicle, and that can be, variable annuities or RILAs or index annuities, versus a guaranteed strategy. So that might be your MYGAs, your QLACs, your DIAs. So what are your thoughts on annuities in the current retirement planning environment?
Well, I think a competitively priced annuity can play a role in a lot of different strategies. And I now that we have this retirement income style awareness, I always think in terms of that and what role an annuity can play with the different retirement styles. There's not going to be a lot of play for annuities in the top half of that RISA matrix with the total returns or the time segmentation, but that's where, if there is a role, it would be more as an accumulations tool instead of for lifetime income. So if your total returns, you might think about a low cost investment only variable annuity if that tax deferral for less tax efficient asset classes is something that could be a benefit. You might look at a RILA, that's the registered index linked annuity. It's a structured annuity that cuts off some of the downside risk. and therefore can give you more of the upside potential than something like a fixed index annuity. Now, if you're in the time segmentation quadrant, you might look at a few different accumulation-based annuities to also think about that front-end piece of funding those retirement expenses. That could be a MYGA or other type of a deferred fixed annuity. That could be a fixed index annuity used primarily for, really as an alternative to bonds in terms of an after-tax competitive yield when it's linked to some index. It's principal protected, so no risk of capital loss, and competitive with other bond asset classes. And then if you get down into the bottom half with the income protection and risk wrap, that's where you're really looking at the lifetime income provisions as a driving motivator for thinking about the annuity. In the income protection world, that can be the QLAC or the deferred income annuity or the single premium immediate annuity or the fixed index annuity with the living benefit that, due to the lapsation and other factors, may be competitive with SPIA payout rates. Those can all be considerations there. And then if you're in the world of risk wrap, that's where a RILA with a lifetime income benefit or a variable annuity with a lifetime income benefit, both of which give you more of that upside exposure to the market. And the contract value takes risk. You can have a risk of loss there, but at the same time, that income provision with the opportunity for step-ups, you benefit when the markets do well, but your income is protected. And so you have that guardrail. If the markets don't do as well, and you end up outliving the contract value of those assets, then you have that protected lifetime income. So that's how I view the different types of annuities and generally how they can fit into the different styles that people have when they think about retirement income.
Well, the big question these days, kind of a follow-up to that, Wade, is inflation. So how do you think inflation factors into annuity purchase consideration and just retirement planning in general, since we're having it for the last year?
Yeah, now that inflation is picking up again, the annuity is not the place to get inflation protection, but often that argument, that's kind of like the end of the discussion. It's, okay, don't use an annuity because it doesn't provide inflation protection. I think that puts things too much into an all or nothing discussion in terms of, is it all annuity or all investments? The reality is people are looking at allocating to different assets. And so an annuity might be part of the mix. It could provide some cost of living adjustment, but that's not protection from unexpected high inflation. That's just an actuarial calculation. You really have to look at the inflation protection elsewhere. And if you're looking at TIPS or Treasury inflation protected securities, unfortunately, you can track inflation as if you're not going to meet inflation because the entire TIPS yield curve is negative at this point. But at least you know, like if there's a negative 1% yield on your TIPS, if inflation is 20%, you're going to get 19%. You're always lagging inflation by 1%. So that's the closest we can get to pure inflation protection. Otherwise, you can also think about the diversified portfolio and the hope that over the long term, at least, a well-diversified portfolio can be expected to at least keep pace with inflation as well. And that's where that can be the source of inflation protection. And the annuity, without having the inflation protection there, but it can offer a higher payout rate than you're trying to spend overall so that you can actually reduce the withdrawal rate from your non-annuity assets at the start of retirement. And that helps manage the sequence risk. That helps better position those assets for growth such that they can be the source of inflation protection over time. The lower initial distribution rate more than compensates for the subsequent fact that all the inflation adjustments have to be funded through that investment piece since they're not being funded through the annuity piece. But in the simulations I do, that sort of strategy can work. Don't worry about the inflation protection on the annuity side. Focus more on the investment side to fund any desired inflation increases for spending.
Makes sense. And I'll throw the same question at Ed. I mean, basically, we're saying inflation's a now issue, not just a possibility. So given all that, how should inflation factor into IRA and retirement planning considerations that your company deals with?
Well, Wade made a great point with the annuities. You know, a lot of the advisors on the program do annuities, and they will be asked that question on inflation. And I would take the same approach that Wade just said. I was going to almost say the same thing, to look at the invested assets. The fact that you have protection from sequence of returns risk. If assets go down, you know, your annuity, there's your protection. Look at what you're not losing. So, you know, it gives you, in essence, more purchasing power without the worry of the loss. So as far as retirement, obviously, if things cost more, you need more money. You can't manufacture money, but maybe if you take it from the right places, so that's what Wade was getting at, rather than be forced to take it from a declining stock portfolio, if you take it from the right places, and that's again, all of these things, I was almost going to interrupt Wade, but he was on fire there. The whole point of looking to the stock assets, the equities there is the key to the annuity part. You got to look at the whole picture of what you're gaining. You know, it's true. The annuities really aren't built for the inflation protection, or you could buy them at some point, but the protection, it's I have this myself. I have it as a buffer in my Roth IRA. And the reason I have it in my Roth IRA, the only thing better than guaranteed income for life, I always tell consumers when I do programs, I always say the only thing better than guaranteed income for life is what I have. And then I let it sit there and they say, well, what do you have? Well, the only thing better than guaranteed income for life is guaranteed tax-free income for life. So that's why I have them in my Roth IRA. But in my Roth IRA, I have the exact scenario that Wade was describing, where I have a stock account and I use the annuity as a buffer.
Exactly. So it's how you combine the whole thing. So let's move on to you mentioned taxes. The lawyer in me says we got to talk about some other things. Okay, we don't have anything from Congress, but we do have two new IRS pronouncements. One is largely for those who don't want to draw down their IRAs. They want to, push it off and let it be inherited. The other is for those who want to get their IRAs as soon as possible, and especially the great resignation folks who are leaving, retiring earlier than they expected. So let's first talk about that RMD rule. So Ed,
well, you know what, before you talk about that, I got to ask you and Wade, this whole, this is the biggest thing. It was the top story on the New York Times business section yesterday, this great resignation. What are these people doing for money? I don't understand it. What am I missing? You just quit?
Well, I'll make one comment. You look at some people who have dual income. So it might be a teacher or a nurse or somebody who says, I'm not putting up with this. I'll be dependent on my spouse's income. And that's why Social Security becomes a very important one. That's one comment I want to make. And others are just saying they don't really understand how it works and they think they're going to tap their 401ks and their IRAs.
Yeah, that's what I mean. And it goes along with this FIRE thing, whatever that stands for, financial independence, retire early. Yeah, early. I see online, yep, I'm 33 and I'm retired. Go ahead, Wade. I don't get it.
Well, yeah, right. I mean, it's the recency bias as well, with markets having done so well until just quite recently. We have to wait and see what happens. But I think people may get overconfident about the ability of that type of investment growth to continue, and therefore feel like they're ready to retire. But ultimately, people may just need to adapt somewhat as well and be flexible with their spending. And that can go a long way towards, if they're tired of working, take the plunge and just be flexible.
I don't know. I was raised in a different generation. Tired of working just didn't cut it.
Well, and let me cover that. I'll kind of reverse the questions I was going to ask you, Ed, is for those people that are retiring early. We had this recent pronouncement from the IRS on SEPs, substantially equal proportion payments. Anyway, this is Revenue Ruling 2022-6, just came out. And I wanted to point something out, and you had some really interesting comments when we were getting ready for this. So Bob Keebler, who many of you know, someone who's been on our guest in the past, gave kind of a startling example yesterday on a webinar that I heard, where it really allows people to get at their money earlier from their pensions and IRAs. And in his example, I just want to point this out, is he was using the fixed amortization method. And we were talking about a 50-year-old female. Now, because they've allowed you to use a 5% interest rate on this, before, if she had started her early withdrawals at 50 in December, she would have gotten $36,122 a year. But now, because of this new change, she could instead take $60,312. That's $24,000 more per year. So I was saying, gee, this is great. You know, you could retire early and get more money, but I think you had some pretty interesting comments about how that fits into early retirement. So have at it, Ed.
All right. First, retirement. They call it retirement money because it's for retirement. Getting it early is usually not a good plan, because then what are you going? Look at life expectancies. You know, one of the things we're going to talk about in the new life expectancy tables, one of the changes on there, IRS raised the ages on the life expectancy tables to 120 years old. All right. I mean, you know, if you start taking your retirement money at 40 or 50 or something, what's going to be left for a long life expectancy? I see you have it on the screen. Nice move there. 120 plus years. I mean, that's crazy. So obviously, this is the law now. You have to live to 120. There's no option. Nope, you got to go to 120. So it's not a good idea, but some people need the money or they use it for tax planning. But I always caution advisors about using what we call these 72T payments. In fact, I usually make a joke at our 2-day program where we cover a myriad of topics. We go through a 400-page manual in 2 days. We put the 72T section at the end. And when I get to it, I say, you know, I put it at the end in the hope that we never get to it. Because, you know, as an advisor, you're going to be on the hook here if you're using this strategy, because the penalties are severe. You have to stay on this schedule. You know, it's not a one and done. Let's say somebody starts at age 40. You have to stay on this series of substantially equal periodic payments, what we call a 72T schedule, because it's easier to say. You have to stay on that schedule for the longer of 5 years or until you're 59 and a half. If you're starting the schedule at age 40, you've got to continue those payments with no modification for 19 and a half years. Most marriages don't last that long. What are the odds you're going to continue perfectly? There could be a mistake. And we've seen cases where somebody blew it in the 15th year. And here's the big trap. You blow it, all the relief. And the whole reason you're doing all this is to be relieved from the 10% early withdrawal penalty. That's why you're doing it. It's an exception to the early distribution penalty. If you do this schedule and you fall off the wagon, even 5-10 years later, the 10% penalty is triggered retroactively, is triggered retroactively for all of those back years, plus penalties and interest. You know, that's I don't want to be on that ticket. You know, a client makes a mistake and then they go right back to the advisor, because they never like to blame themselves, and they say, well, you said this would work. I thought I could change it. Another big mistake, people change the payments. That is a modification that blows the schedule. Or they roll money into the account to think they can get a higher payment. That a modification, it blows the schedule. Or they combine it with another IRA, changing the balance. That's a modification. You can't do that. So you got to be very careful. This thing's like an eggshell. You break it, it's over. So I would be very careful. Yes, it can be used, but it must be monitored each year to make sure you're making the right payment each year.
And on the flip side, it's worth mentioning with these tables now, for people who are trying to defer their RMDs, it's obviously very favorable, because obviously it says you're going to live longer than you said before. So we just started using these lower factors this year. Any comment on what you're seeing relative to that?
Yeah. Well, here's a fun fact. They raised the age from 70 and a half to 72. So if you look now, you start at 72. What's the life expectancy factor? I see it there right on the table, 27.4. That's what you start at. When you started at age 70 under the old table, the life expectancy was the same. This is the old table, same 27.4. So it's kind of a wash when you compare the two tables, by starting later. But yeah, it lowers your RMDs a bit. What we did on these tables you're showing, and this is a great tool for advisors, and you're welcome to have it, whoever wants it. You see that other column we put there, Steve, on the percent of account balance? You don't get that on the IRS tables. We added that because that's something clients always ask about. They don't understand the concept of years. And we found over years, they made big mistakes. They saw 27.4, they took out 27.4%. That's years. So what we did, and this is very valuable to advisors, we gave them the actual percentage that correlates to. So you can tell the client, well, at age 76 here, you're taking 4.2%, so to speak. So they can manage that. And this flies in the face of what Wade was talking about, and other people talk about the 3% withdrawal rule or the 4%, whatever it is. If you have all your money in IRAs, you're starting with mandatory distributions at 3.65%. But get the new tables. It will, for most people, lower their RMDs a bit.
It'll lower your RMDs just for those that are very affluent or high net worth. It'll also raise their net worth, and it could cause some problems on the estate planning sides, but a topic for another discussion. Wade, we've kind of covered several tax topics, but I know you've been doing some work with Roth and IRA planning. Any other ahas to consider for 2022 in tax planning before we get closer to the Q&A section?
Sure. Yeah, we're getting short on time here. And the tax planning, I've been trying to look at the questions as they came in, and there's a lot of basic type questions on the tax planning. So the chapter 10 of my retirement planning guidebook is the longest chapter. It's about 70 pages, and I try to cover it all in detail here. But yeah, I mean, the big ahas, and this is
my favorite chapter. It's all about tax.
Big chapter. But there's three things. It's not just marginal tax rates in the federal tax code or the state income tax code. You want to be cognizant of when you have taxable ordinary income, is that pushing some of your preferential income, long-term capital gains, or qualified dividends into higher, because they have a whole separate tax bracket system, pushing that into higher tax brackets. You want to be cognizant of your Social Security benefits. And as you generate more ordinary income, this is more an issue for like middle-class retirees. Are you going to be pushing yourself into having to pay taxes on more of your Social Security benefits at the same time, and managing that Social Security tax torpedo? And then for people who have a bit higher income and so forth, the whole Medicare IRMAA situation, where if you're generating more taxable income, whether it is through distributions from an IRA, whether it is taxable long-term gains and so forth, or other income sources in Social Security and so forth, are you pushing your modified adjusted gross income above thresholds that 2 years later result in higher Medicare premiums? And so a lot of the tax planning is, when you're looking to pay lower tax rates, it's not just federal income tax rates or state income tax rates. It's this combined impact. What is your taxable dollar doing to your Social Security benefit, to your long-term capital gains, and potentially to your Medicare premiums at the same time?
That's right. It's more than just your tax rate. The Medicare IRMAA thing is the one that's the trickiest for two reasons. Number one, you don't see it on a tax return. It's billed separately, either deducted from your Social Security or you pay it separately. But it doesn't show as an extra tax on your return like the Social Security might. So it's kind of hidden. You have to add that in. The other reason the Medicare IRMAA parts D and B and D is tricky is because it has a 2-year look back rule. So here's an example of some planning you can do. If you're thinking about a Roth conversion, for example, you think about a Roth conversion, if somebody's already on Medicare, yes, it could, depending on their income levels. And remember, it's a cliff. So you're $1 over a bracket, it could cost you a fortune in IRMAA charges. So here's an idea. Why don't you identify the clients, especially for Roth conversions, who are 62 and under? See, most people don't understand the 2-year look back. You might have a client who says, well, I'll do the Roth conversion at 63. I'll beat the IRMAA charges. No, you won't. If you do it at 63, 2 years later, it's going to impact those IRMAA charges. So here's a great tip for Roth conversion planning. if people are worried about the IRMAA charges because they're higher income and they're based on brackets, have them do a series of smaller annual conversions over time, building up to get it all out maybe by the time they're 62.
Exactly. Yeah. In fact, I want to make sure we get to something here, Ed. We're getting tons of questions in the Q&A.
I know Sarah and I are killing it. I told you they would.
Yeah, well, we're surprised? No, of course not.
No, I'm not surprised.
This is a chance to tell people where to get those charts. And by the way, yeah, using percentages instead of factors is great. So we're getting a ton of questions. How do they get at the charts that you were talking about?
Oh, yeah. I opened my big mouth. So tell them how like Jackie Gleason, I got a big mouth, but I'm happy. Can you get them the charts somehow? I hate to put you on the spot, but.
Sure, we can do that. So that's something that we could do as a follow-up, assuming we actually have the email of the person that signed up. Yeah.
All right. So we just answered 100 questions right there.
Yeah, it's all four that I see on my screen right now. How can we get those tables?
Yeah, that's a big one. The other thing I guess I would mention is just a reminder, we have the RICP program that we can do for the people who want to get to designations. But again, we have what we've worked out with Ed and his fine people are answering this question that you can really focus in on just IRAs. So keep in mind, there's a lot of ways to follow up and use this information. Do either one of you see anything else that you want to handle? And I mean pretty quickly, because we always like to close at the hour, but that you're seeing in the Q&A that
I saw a great question here. I can't tell who it's from because it's just initials, but it talks about Roth conversions before RMDs begin. That's a great point, whoever made it. If the RMD age goes up to 73, 4, or 5, it leaves you more room to do Roth conversions, because once RMDs begin, those RMDs cannot be converted. The first dollars out have to be the RMD. So that was a good point somebody made. Try and get your Roth conversions in before RMDs begin.
Good, and I see we've posted IRA success up on the chat function,
and that's taught by the best in the business. You see two of them on the program today: Sarah Brenner and Ian Berger, and also Andy Ives and myself.
Right. Okay. What else? Just looking very quickly, you could probably handle one more question.
Yeah, I saw one maybe worth mentioning. Now that inflation is picking up, a misunderstanding about Social Security. Sometimes people think you have to claim to get the COLA adjustments, and that's not the case. Regardless of whether you're starting from age 62, your benefits will be growing with the annual cost of living adjustment. You're not somehow missing out on that by delaying Social Security.
Right. So deferring does not lose that 5.9. And again, my example with Medicare had to do with IRMAA, but you still get the 5.9 or whatever it is counted towards it.
That hold harmless provision doesn't apply to the IRMAA. That's where somebody who's paying the additional Medicare premium can see the drop in Social Security.
And we really appreciate all the good questions and comments we had as we went along. And again, to remind you of RICP and the Slott IRA success courses, we really hope you follow up with that. I want to make sure as we hit the top of the hour, I thank these two great book writers, Ed Slott and Wade Pfau. And thanks a lot for all the great things you do to help people as we go along. And we just hit the top of the hour. So thank you much, everybody.